category. And this is when the ownership is between 20 and 50%. So larger than this, the ownership is larger than this financial assets category. So when we're talking about this category, this category is also called equity method investments. And here the investor owns about between 20 and 50%. So as I said, there's often one board member from the investor. Maybe the CEO or the chairman has a seat on the board of the investee, and the investor has significant influence. That means that it can influence the operating and financial policy, but it cannot control it. Control is only possible if you have more than 50%. But nevertheless, the investor can affect the dividend policy. It cannot decide completely, but it can affect the dividend policy. For example, we talked about Berkshire Hathaway and Warren Buffett. And the company Berkshire Hathaway, for example, has a stake in Kraft Heinz. So maybe you know Kraft Heinz, and Kraft Heinz produces ketchup, for example. Ketchup and other goods you can buy in the supermarket. Kraft Heinz. And Berkshire Hathaway owns, I think, about 26% of this company. So Berkshire Hathaway can influence the policy of this company, but it cannot control it because it's not 50%. So then, if you have such a holding between 20 and 50%, you have to use the equity method. There is one exception, and then that is when the business is held by a venture capital firm. Then you have to opt for fair value through profit and loss. So the venture capital firm has to choose the fair value through profit and loss category. But this is also this is only for venture capital firms. All other firms have to use the equity method or investments in associates method. And so the question is, what is the equity method? Initially, the investment is recognized at cost, and initially it's recognized at cost, and thereafter it is adjusted for change in the investor's share of net assets of the investee. So net assets, what does net assets mean? Net assets means equity. So whenever equity changes of the investor, then the equity of the investee whenever an equity of the investee changes, then this has to be adjusted on the balance sheet of the investor. So basically it is the book value of the equity of the investee which is shown on the investor's balance sheet. And whenever the book value of the investee's equity changes, then the asset has to be adjusted. And so this is the balance sheet here. This is the balance sheet. This is the income statement, and in the income statement of the investor, the income statement of the investor includes share of the profit of the investee. Yeah, so it is called a share of the profit of the investee. Whenever an equity method investee has made a profit, then the investor, of course, has to adjust for that. So the equity earnings appear on the investor's income statement. Yeah. Where else should they appear? They are on the income statement, of course, and typically it's listed under financial income. Yeah. And they are often labeled as share of profits of associates. Sometimes they are also called income from equity affiliates. Yeah. And if an associate, if the investor has a loss, yeah, then that leads to a reduction in income of the investor as well, of course, yeah, and a reduction in net assets in investments in associates. This is the equity method, yeah. So basically, you show the equity portion of the book value of your investee on the investor's balance sheet, yeah, on the assets as an asset. And whenever the book value of the equity changes of the investor, then you have to adjust for it, yeah. And this is the category where you own 20 to 50%. It's called investments in associates. Yeah. And this is the third category, consolidated investments. So here we're talking about the last box. Yeah, we're talking about the last box. This is this, where the investor owns more than 50%. Yeah. And then we have here the investor controls the investee company. And we are talking about long-term investments. Yeah, think about when a business owns more than 50% of another business, then this is really controlling interest. Yeah, then this is really controlling interest, and then you are typically in there for the long run. Yeah, you do not buy more than 50% and then sell the stake for after a couple of weeks or months. This is not the way you would probably do it. So this is called investments in subsidiaries or consolidated investments. Here the investor has to control the investee, which it means typically it's an ownership of more than 50%. Yeah. Why do companies acquire control over another company? Think about it. Why do companies acquire control over another company? Okay, make decisions. Yeah, they have the power to make decisions, the power to change the financial policy, the power to make more money. Yeah, maybe the power to appoint directors, maybe to remove competition. Yeah, or just it might also be possible that it's only a financial stake. Yeah. So when you think it's good to buy 2%, why shouldn't you buy 55%? Yeah. So, but all you said is correct. So typically the ownership is more than 50%. What we do here, this method we're talking about is called the acquisition method. Yeah? In earlier times, there was also another method which is called a pooling method, but we do not talk about this here. Currently, pretty much all the prevalent accounting standards, accounting rules, they use the acquisition method. We have a parent company, which is the investor, and we have a subsidiary, which is the investee. Yeah, parent company is the investor, a subsidiary is the investee. And a stake of the parent is called the controlling interest. Why the controlling interest? Because the parent controls the investee. Yeah, when you have a controlling interest and you do not own 100%, you also have a non-controlling interest or minority interest. There is, which is the stake that is that belongs to a different party. But we will come to that later. When we're talking about investment in subsidiary or consolidated investments, we have three sets of financial statements. We have the financial statements for the investor. Yeah, we have the financial statements of the investor, or the parent, as it is called. Yeah, parent. Parent means you are the investor and you own more than 50%. Now, parent. And we have the financial statements for the subsidiary. That is the company the investor invests in. And then we have the financial statements for the group. The financial statements for the group. This is the combined entity. This is the combined entity. Yeah, the group. In Germany, we call the group a concern, and that means that is the combination of all the companies that we are talking about, the parent and the subsidiaries. Yeah. So what does consolidation mean? Consolidation means we combine the financial statement of all the firms owned by the investor. Yeah. So you combine the statement of the parent with those of the subsidiary. Yeah. And the result is a single set of financial statements for the consolidated entity. So if you own shares of Volkswagen, yeah, imagine you are buying shares of Volkswagen. then you want a single set of financial statements for the whole group. Yeah, also for the subsidiaries that Volkswagen, the Volkswagen AG, has invested in. Yeah, so think about, for example, Volkswagen owns Audi and Bentley. Yeah, Audi and Bentley, they are also car companies, and they are owned by Volkswagen. And that's why you want them to be included in the financial statements of the group, and that's why consolidation is necessary. So the combined entity is called a group, and the group has the name of has typically the name of the parent. So if the parent is the BMW AG, then the consolidated entity is the BMW Group. Yeah, and the group is actually it's an economic entity. Yeah, it's not a legal entity. Yeah, so that means, for example, you cannot get sued by a group. Yeah, you cannot get sued by the BMW Group. Yeah, because it's only an economic entity. It's not a legal entity. Yeah. So how does the consolidation work? How does it work? You add all the assets, all the liabilities, all the revenues, and all the expenses of each subsidiary to the parent's accounts. Yeah, and you use the fair value. Yeah. So when the parent buys another company, which becomes a subsidiary, sometimes fair value adjustments are necessary. Yeah, so you have to adjust the fair value, because the fair value might be something different of one single asset or liability, might be something different than the book value of the asset or liability as it is shown in the subsidiaries financial statements. Yeah, so you might adjust the fair value, and you might recognize unrecognized assets and liabilities. Yeah, and then if there are payables or receivables against each other, they have to be eliminated. So if an investor company, if a parent company has a account receivable against a subsidiary, it has to be eliminated. Do you have an idea why does it have to be eliminated? When we're talking about the group statements, why does it have to be eliminated? Think about, you have the Volkswagen Group, and Volkswagen AG has an account receivable against Audi. When you think about the Volkswagen Group, which is the combined entity, why does the account receivables not? Why does the account receivable not does not have to be or should not be included in the financial statement of the group? Any idea? Think about it. Why do accounts receivables and payables have to be eliminated? Exactly, because Liang, you say the parent company pays to the daughter brand. It actually a company, an entity cannot have a receivable against itself. Yeah. So if Volkswagen has a receivable against Audi, and Audi is the subsidiary of the Volkswagen, and all belong to the same group, then it doesn't make sense. If you are interested in the whole entity, you do not want to see that, because an entity doesn't have cannot have a receivable against itself. Yeah, it cannot have a receivable against itself. Yeah, and if you are an investor and invest in the Volkswagen Group, want to invest in the Volkswagen Group, it is not interesting to you whether Audi has an account receivable against Volkswagen, because both belong to you essentially. When we're talking about consolidation, the consolidated balance sheet does not include the asset investment in subsidiary, and not the subsidiary's equity. They have to be eliminated. They have to be eliminated, and we will see why. Yeah, so investment subsidiaries and subsidiaries equity have to be eliminated. We will see why soon. There are two accounts that only a consolidated entity can have. The first is goodwill. Goodwill is an intangible asset. And can you tell me more precisely what goodwill means? What is goodwill? Yeah, reputation has to do with reputation, correct, Liang? And it is shown on the balance sheet when one company acquires another company, and it pays more than the net assets of the acquiree, yeah, of the acquired firms. When it pays more, when the price is higher than the net assets, then the remainder is goodwill. The remainder is for the reputation of the firm. Yeah. So it's an intangible asset, and it's shown on the consolidated balance sheet. Yeah, but this is correct. It's for the reputation of the firm. If you would like to acquire, let's say, Coca-Cola, yeah, probably have to pay a much higher price than the net assets on the balance sheet. Why? Because Coca-Cola is such a good company and it has such a good reputation. And that's why the purchasing price is probably much higher. If you acquire the entire company, your consolidated balance sheet has to include goodwill. Yeah, and the goodwill is the remainder, the difference between the purchasing price and the net assets of the balance sheet of Coca-Cola. And then there is another account that only a consolidated entity can have. As I said, when you have a consolidated entity, it means the parent company owns more than 50%. If the parent company owns more than 50%, but not 100%, then there is also a minority shareholder, or many different minority shareholders. Why? Because there's a gap between the ownership of the majority shareholder and 100%. Yeah. So if a company owns less than 100%, then there is an account called non-controlling interest, and it has to be included in the combined balance sheet. Yeah, this is called non-controlling interest or minority interest. So here you see at a picture how it works. On the left hand side, you see the balance sheet of the parent. Yeah. So here we have the balance sheet of the parent. We have the assets of the parent. This is in blue. We have the liabilities of the parent. Yeah. By the way, one of the assets of the parent on the balance sheet of the parent is an asset which is called investment in subsidiary. Investment. This has to be in investment. Investment in subsidiary. No, sorry, I don't know why it doesn't show up here on the slide. Investment in subsidiary, and so this is the balance sheet of the parent. On the right hand side, in the middle, actually, you see the balance sheet of the subsidiary. See all the assets here, all the assets of the subsidiary. You see the liabilities of the subsidiary, and you see the subsidiary's equity, which is the remainder between the assets and the liabilities. And so in this instance, we assume that the subsidiary is 80% owned. 80% owned by the parent. So we have a parent here. We have a parent, and we have a subsidiary, and the subsidiary is 80% owned. Is 80% owned by the parent. And what you do in consolidation, you oppose the asset investment in subsidiaries to 80% of the subsidiary's equity. Yeah, you oppose the investment in subsidiaries to 80% of the subsidiary's equity. Why is it 80%? Because the parent owns only 80% of the subsidiary's equity. So you only take 80% of the subsidiary's equity and you oppose them against each other. And here you see that the investment in subsidiary, the green box, is much larger than the orange box. Yeah. And the difference between the two is goodwill. Yeah. So you see that the investment in subsidiaries, which is the purchasing price, is much higher than 80% of the net assets of the subsidiaries. Net assets equals equity. Yeah, as equity equals net assets. You oppose the purchasing price, the investment in subsidiary, to 80% of the net assets. To 80% of the net assets of the subsidiary, and the remainder is goodwill. Yeah, this is what you pay for the reputation. Yeah, for the reputation. This is what you pay for the goodwill. It's what you pay for the reputation. Yeah, and you see here that the purchasing price, which is the investment in subsidiaries in green, is much bigger than 80% of subsidiaries equity in orange. Yeah, and the remainder is for the reputation of the firm. It's goodwill. Yeah. Does that make sense to you? Are you with me? Are you still? Yeah. So on the consolidated balance sheet, which is here on the right-hand side, you have to include the goodwill. You have to include the goodwill, and you have to include the goodwill. And put it on the balance sheet. There is another account which is called non-controlling interest, and this accounts for the fact that you only own 80% of the subsidiary. You only own 80% of the subsidiary, but the assets and liabilities, yeah, the assets and liabilities of the subsidiaries, they are included with 100%. Yeah, if you look at the assets and the liabilities on the consolidated balance sheet, they have the same size. They have the same size, which means they go in with 100%. Yeah, they are as you include the assets of the subsidiary and the liabilities of the subsidiary completely. Also, the ownership position is only 80%. Yeah, and for this, and because of that, you have to take into account that you have a non-controlling interest. Yeah, and a non-controlling interest, actually, what is a non-controlling interest? It's part of equity. It's a part of the equity, but it's not the part of the equity that belongs to the parent. Instead, there are minority share owners. Yeah, in our case, it's 20%. This is the 20% of the shares that do not belong to the parent. Yeah, so 20%. And they also have a stake in the company. Yeah. So this is the 20% of the equity. And this is the 80% of the equity. Does that make sense, or do you have any questions here? About are there any questions? Or it makes sense? Okay. If it makes sense, then we can go on. So far, we've talked about the balance sheet of the consolidated entity, of the combined entity. Liang asked how to know the investment in the subsidiary. The investment in the subsidiary, this is an asset which is shown on the balance sheet of the parent. Yeah, this is an asset which is shown on the balance sheet of the parent, and this is only this is only there if the parent buys another company, and the other company is of course the subsidiary. Yeah, and when one company buys another company, the parent company has to show investment in subsidiaries. And what's the amount? It's the purchasing price. It's the purchasing price. So let's say we are let's say we are one company. Let's say we are Nestle, and we buy Coca-Cola. Yeah, and let's say, okay, Coca-Cola is very expensive, and we have to buy 200 billion. Then on our balance sheet of the parent's balance sheet, Nestle's balance sheet, we have to include the investment in Coca-Cola. And what's the amount? The amount is 200 billion. Yeah. So in our case here, this is 200 billion. Yeah. When these 200 billion are larger than the net assets and 80 or then whatever fraction you buy of the equity's net assets, then you have goodwill. Yeah. So investments in subsidiary is the purchasing price of the subsidiary. It's an M&A. Yeah, M&A is correct. Yeah, if one company buys another company, it's M&A, and M&A stands for mergers and acquisition. Does it make sense now, Liang and Ray? Okay. Yeah. So far we talked about the balance sheet, of the consolidated entity. This is about the income statement, and the income of the consolidated entity is the net income of the parent, of course, of the investor company, and parent's part of the subsidiary's net income. Yeah. And we have the same very similar thing we have if own parent company owns 80% of the subsidiary, then it has to include 100% of the revenues and 100% of the expenses, even if it's only 80% owned. Yeah, and the reason why this works is because we have non-controlling interest. Actually, this is very similar to our balance sheet. Yeah, in the balance sheet, we have also included 100% of the subsidiaries. Of the subsidiaries' assets and 100% of the subsidiaries' liabilities. Also, the subsidiary is only 80% owned. Yeah, and it works. Why does it work? Because we include an account which is called non-controlling interest. Yeah, and this is the same for the income statement. Here we also have the income statement of the parent. Yeah. So here, parents. This is parents' revenue, parents' expenses. If you deduct the expenses from the revenue, you have the profit. Yeah. This is the subsidiaries' income statement. Here we have the parents' income statement. Here we have the subsidiaries' income statement. Subsidiaries' income statement. Subsidiary also has revenues, has expenses, and has profit. When we look out at our consolidated income statement, we include, of course, the parents' revenues, and the parents' expenses. This is the same. Yeah, this is 100%. And this is all the same. 100. All include 1% of the subsidiary revenue. Subsidiary expense. We put 100%. It is, as it can sound a bit strange, because why do you include 100% and own 80% of the company? And the reason is they have non-controlling interest. The non-controlling interest. And this is part of the subsidiary, which does not belong to the parent. This part of the profit is the part of the profit of the subsidiary that belongs to the parent. Yeah, it belongs to the parent. 80% belongs to the parent because the parent owns 80% of the company. Yeah, but there is a minority interest, which is 20%, which is also profit of the combined entity, but it does not belong to the parent. So think about if you are a share owner of the parent. Of course, you're interested in the profit of the subsidiary, yeah, because the subsidiary belongs to the parent. But you are only interested in 80% of the profit of the investee, because only 80% is owned by the parent. The remainder, the 20%, are owned by some other parties. Okay, does that make sense? Or are there any questions here? Exactly, yeah. Liang, is correct. Minority interest is 20% of the subsidiary's profit. Why? Because 80% belong to the parent and the remainder is 20%. So this is profit, but it does not belong to the parent company. Okay, all right, very good, very good. Then we have another break. See you in 50 minutes.